Next thing we're going to talk about now is learning objective 5-3. What happens when a parent ceases to be consolidated? In other words, when a parent has control of a subsidiary, then it's going to consolidate. And if it loses control of the subsidiary, then it doesn't deconsolidate, it just stops consolidating. So what happens then? So in general, if it can no longer exercise control, then a parent stops consolidating. And control can be lost for a number of reasons. Maybe the parent sold its interest. The subsidiary might have issued so much additional common stock to someone else besides the parent that the parent no longer has that financial control of the sub. The parent could have entered into some kind of agreement, or the subsidiary may have filed for bankruptcy, in which case is being controlled by the bankruptcy court and not by the parent. So in that situation, if the parent loses control and no longer has that controlling interest, no longer holds any controlling equity interest, as the situation we'll talk about, then what would happen is the parent would recognize a gain or loss on the difference between the proceeds and the carrying amount of their equity interest. And the parent may still have some equity interest, but when it enters into this event where it loses control, then it needs to evaluate whether there's a gain or loss. And by the way, previous years that were consolidated would still be consolidated. They would just stop consolidating as of the date of the acquisition. So what that would mean is that you would still, let's say you discontinue consolidation on June 30th in the middle of the year, you would still need to consolidate the first half of the year. But then the balance sheet, for the purpose of the income statement, for purpose of the balance sheet, then the balance sheet will no longer be consolidated as of year end. Peerless sells 75% of its 80% share in Special Foods on January 1st, 2012. It should be 22nd. For $246,000. The fair value of Special Foods, the entire company, is $410,000. So the carrying value of 75% of their 80% share is $314,700. That's $410,000 times 75%. So that it's not because this is the carrying value. This is what's on their books right now. It's $314,700. So what we do is we kind of do a master reckoning of our entire share. In other words, we treat this as if we are receiving $246,000 and 25% of this, the remaining stock that we're still going to have, and then what we got for it. So we sort of do a massive reckoning and we record a gain and loss on everything. So the cash proceeds here were $246,000. And all of Peerless is worth $410,000. And we are going to own, after this is all done, 20%, because 75% of 80% is being sold. That's really 60% of Special Foods. So 20% of Special Foods is what we're still going to have. Let me repeat that again. We're selling 75% of our 80% share. So 75% times 80% is 60% of Special Foods. 20%, we have an 80% share, 60% is going, but 20% we're still going to hold on to. So after the transaction is over, we are going to have $82,000 worth of stock in Special Foods. So the total things that we're going to have after this is all done with is $328,000, $246,000 in cash, and stock in Special Food that's worth $82,000. So we're getting a total of $328,000. Now, we're really not getting it. We're getting $246,000. But the way we put this is we look at the whole package. And it's not just the cash we're receiving, but it's also this remaining interest of $82,000. Now, what are we losing? We are giving up stock that's on our books right now for $314,700. So that would mean that we have a gain here of $13,300. So what I would do here is I would debit cash for the amount of money that I receive in this case, $246,000. And I will credit the gain account for the amount of gain that I have, $13,300. And the difference between these would be the, let me write here the full amount, gain on sale of investment. And the difference between these will be a write-down of the investment. And if you do the math, you can see that this would be equivalent to the fair value of this investment on the date of the discontinuance. So we said that that was here, it should come to $82,000 because previously you had carrying value of $314,700, and now you have this gain. So this would come down to $82,000. $314,700 minus $232 would come to the $82,000 fair value of that interest. And now it would be carried at $82,000. And if you have substantial control, substantial influence, then you're going to use the equity method. And if you don't have substantial influence, then you're going to use the fair value method.